Discussion. Welcome to ESGX Live, the community for education and information to inspire collaboration and action. And it is a very special episode today. It marks exactly 1 year since we first started ESGX Live, and it has been a fantastic journey ever since. And one of the consistent themes is that we have, through the wisdom of our guests, I'd say, as much as anything else, been ahead of the curve. So you will remember we had Jigar Shah on in early January talking about the future of energy. And of course, he now has a significant role in the Department of Energy itself. And then later that month, we were talking about Reimagine Appalachia and the importance of rebuilding in that region. And apparently, Joe Biden is going there tomorrow. So thank you very much for everyone who steered us in that direction. Now, just as a very brief introduction, of course, we've also talked for a lot of the last year about building back better. And a series of politicians around the world themselves have been talking about building back better. And one of the things which, of course, comes up in all of this is, what does this really mean? One thing that we've seen is that there is a huge amount of money flowing towards sustainability. You'll have seen, perhaps in the little video beforehand, the figures from Bloomberg New Energy Finance at the beginning of the year. Over 500 billion has flowed into the energy transition. Similarly, in the world of sustainable investment, the amount of money that has flowed into ESG-related funds has grown by a factor of almost 10 since 2018, which is a really, really significant amount. And then, of course, just to add a little bit more to this, I woke up this morning to see this advertisement run on my phone.
What is the ultimate safety test? This is the big one. So is this the ultimate safety test? It depends whether you...
So I thought that was pretty good, and a nice reminder that yet another major car company is committed to complete electrification by 2030. And indeed, by 2025, Volvo anticipates having half of the cars it sells being electric. So with that as a little bit of good news, let me hand to Paul Herman to introduce today's episode.
Thank you, Nigel. Hello, everybody from San Francisco, where it actually is sunny, not just my background. And we are likely to hit 75 degrees Fahrenheit, over 20 degrees Celsius today. And we will see how hot a summer it becomes. That might trigger some of that ice to melt and that Greenland ice shelf to shift and to risk sea level rise. But we are optimists here at ESGX, so we're going to talk about solutions. So our episode today is we're going to do our monthly Green Jobs Report. So Amir Khalegi and Dr. Fadil Kaboub and Dr. Scott Fulweiler will share the latest results. We'll do that for the next 10 minutes or so. And then we'll have Lauryn Agnew of the Bay Area Impact Investing Initiative and the new author of the, whoops, can't see it, in the Global Handbook of Impact Investing. There we go, Global Handbook of Impact Investing. And she wrote the chapter on place-based investing, so a deep dive. So we're going to touch on several of those issues today. As always, use the chat box or the question box to ask your questions, and we'll be interactive and engaging. And we'll do a little poll, actually, after the Green Jobs Report. We'll do a little poll for your thoughts about place-based impact investing. So start thinking about what your place is, how you consider place, at least geographically speaking, is how we've interpreted it, and where that might apply in your portfolio. So let's get started. Amir Khalegi, who will be a PhD sometime soon, and deep in his PhD studies. Amir, tell us about what the latest Green Jobs Report says, and how close are we to building back better, as Nigel introduced.
Perfect. Thank you, Paul. So, yeah, thank you for the introduction, Paul, and thank you for those of you who are joining us on our March Green Jobs Report. And for those of you who are just joining us for the first time, our monthly Green Jobs Report measures the direction, momentum, and changes towards a greener, more sustainable economy and the jobs that are related. Our analysis begins by looking at a comprehensive catalog of companies that's provided by Paul and his team at Hip Investor. And these companies are rated with an overall human impact plus profit rating, which is based upon performance, products, and management practices, which include detailed metrics on health, wealth, earth, equality, and trust pillars with a focus on people, planet, and trust. So with this comprehensive catalog of companies, we then map them to their specific industries. And this industry data is provided by the Current Employment Statistics Survey, which is a survey that is conducted by the Bureau of Labor Statistics. Once the companies are mapped to their specific industries, we then place a employment weighted average towards the companies with the HIP ratings to finalize the HIP scores of their specific industry. So the greenness of industries will vary. The greenest, highest rated industries will be that of a HIP score between 75 and 50. Medium or slightly extractive industries will have a HIP score of 50 to 25. And the most extractive, lowest rated industries will have a HIP score of 25 to 0. So looking at the bullet points, these are some examples of the industries that are included within the varying buckets. And overall, our analysis features 191 industries within the US economy. So something that we've consistently found as a trend is that jobs within greener industries have remained the most resilient in regard to the COVID-19 crisis. And proportionally, greener industries have been the least impacted by the COVID-19 crisis, while the lowest tiered, most extractive industries have had the highest proportional job loss. So looking at this chart here, it's comparing the February 2020 employment levels to the January 2021 employment levels. And as you can see, when comparing the extractive to green industries, extractive industries have been reduced by almost double the amount of employment as compared to the green industries. Something that we've seen that was pretty significant, right, since November and going all up until January was the first reduction in employment since the beginning of the recovery of the COVID-19 crisis. So it was the first downturn. But actually, thankfully, starting in February and persisting through March, we've seen a return of job creation, a pretty significant return of job creation. But as an outlier, this was actually the first month that the greenest industries were reduced proportionally more as compared to the extractive industries. But what we wanted to highlight is that the movement of the green industry bucket is more sensitive to employment change due to the amount of jobs that are within the green industries, right? So as a proportion of the entire employment pool, the green industries represent around 5% of the total employment, whereas the extractive industries represent around 20%. So that 0 to 25 bucket. And touching upon the note of building back, right? Building back the jobs of America, as a point of our report and with the help of our viewers and the help of policymakers and what we're advocating for is to build back towards that greener bucket and not go back to the same complexion of jobs that we had within the economy. And that it just goes to our point of trying to build and advocate towards a more sustainable, societal, beneficial economy. So moving on. Our graph here is looking at products and services. And this is one of the pillars that is included within the HIP rating score. And the change from December to January, the industries with the highest rated products and services experienced the largest proportional gain within employment. So when comparing the 75 to 100 bucket to the 0 and to 25 bucket, the proportional gain of the greenest products and services was almost triple or over triple the amount of that compared to the extractive industries. For the middle buckets, there were marginal increases and decreases. So for the 25 to 50 bucket, there was an increase of 0.13%, whereas the 50 to 75 bucket, there was a marginal decrease of 0.2%. So touching upon the positive job creation that was experienced in February and March. So within our last report, we had a slide that was highlighting these seasonally adjusted initial claims for the week of February 13, and it had a figure of 861,000. And even looking out through February, it was trending towards a decrease, and that trend has continued. So when looking at the most recent numbers from the week of March 20th, the seasonally adjusted claims were reduced by almost 200,000 with a figure of 684,000. And looking at the preliminary numbers from the current employment statistics survey for the change from January 2021 to February 2021, there was a large increase of jobs of 464,000. So very positive news in terms of breaking out of that trend from November to January in terms of the decrease in employment. And still, right, green jobs have paid significantly more. So not only being more resilient towards the COVID-19 crisis, they still remained the highest paying jobs by a very significant amount, over $10 per hour when compared to the slightly extractive industries, and even over $12 per hour difference when comparing to the most extractive industries. But still, taking note of the sensitivity of change due to the lower employment pool of green industries. This was also the first time that green industries decreased by the largest amount as compared to the slightly extractive and extremely extractive industries. So over the month change from December 2020 to January 2021, green industries decreased by 52 cents, whereas slightly extractive industries decreased by 4 cents, and increased by 4 cents, and extremely extractive industries increased by 9 cents over the month. So another portion of our green jobs report is looking at the most at-risk, high-contact sectors of the economy, especially due to the restrictions of the COVID-19 crisis. Our analysis mimics the St. Louis Fed's occupational analysis of jobs throughout the economy. And for high contact industry sectors, they don't allow for social distancing, whereas the jobs within low contact industry sectors do allow for social distancing. So looking at this graph here, when comparing the absolute amount of employment from February 2020 to January 2021, we are still below the February 2020 level for high contact industries by an amount of 5.4 million. And when comparing the low contact industries over that same period, we are around 2.2 million below that figure in February 2020. But even within high contact and low contact industry sectors, industries that had a higher HIP score were more resilient towards job loss. So looking at the below 30 HIP score for both high contact and low contact industries, you can see that there's a significant increase in reduction as compared to the above 30 HIP score when in both high contact and low contact industries. So the key takeaway here is that even in high contact sectors of the economy, greener jobs, greener industries remain more resilient to job loss when compared to the extractive jobs or extractive industries. So just to touch back, there has been quite a bit of community focus on our past Green Jobs Report. So looking back to our discussion from September 2020, which featured our guest, Dr. Carolyn McCallahan, she highlighted the needs of the community in terms of primary care health-related needs. And she identified through her study, or through a study from the University of Pennsylvania called Impact Study, that over 400 million people had primary care health-related needs, and that provided a growth capacity for green jobs, right? And green jobs, it's a very broad definition. Yes, they're focused on environmentally sustainable jobs, but also it includes the whole cloud of societally beneficial jobs, net beneficial, with a focus on, people, planet, and trust, and not just profits. But looking towards the growth capacity of green jobs, especially within community primary health, there was an estimated 1.9 million jobs that would be created with the addition of community health workers. And the advantage of these types of support occupations in health is that they require short on-the-job training while also providing meaningful jobs for those who are currently unemployed. And another advantage was that many of the workers who lost jobs within the COVID-19 crisis, whether it be the air transportation, leisure and hospitality, even within the medical field, people losing jobs, there were transferable occupational skills that could go towards community health. And by pushing forth an initiative like that, there would have been rippling benefits for both the worker and the members of the community. So how would we pay for it, right? Within our November 2020 report with Raul Coriello and Sylvia Chi, we had an overview on public banking, which they had a bill that highlighted investments towards the local community and providing banking services that had a triple bottom line approach, which prioritizes people, planet, and trust, with a contribution to the real economy of sector-based communities, basing investments on their specific needs. And that goes directly in line with our topic this month in terms of place-based impact investing with Lauryn Agnew, who is the founder of the Bay Area Impact Investing Initiative. And broad goals of the public or place-based impact investing is maintaining focus on connecting local communities through creating investment strategies centered on focused investment on specific needs of marginalized communities with the intent of improving lives. Also, to create a healthy and thriving community environment, which would be done through increasing the available capital for positive social, economic, and environmental impact across a wide range of asset classes. And more importantly, there's a need for collaboration amongst those who provide investment services, policymakers, community leaders, and concentrating these collaborative energies and resources into one place for and to solve the unique needs and challenges for the community, rather than trying to provide band-aid solutions of this one solution will fix all the needs of the community, because as anyone will know who tries to solve these issues are far more complex than just one solution solve all. So, with that being said, super excited for the discussion to follow. And thank you for those of you who are joining us. It's going to be a very interesting discussion. So, Paul, you can take it away.
Great. Thanks, Amir. And this is 1 year into the Green Jobs Report, too. So we did a 6-month feature on sustainablebrands.com to look at the results. And so we'll likely have a 1-year update report coming soon. All right, so delighted to welcome Lauryn Agnew of the Bay Area Impact Investing Initiative, and a essentially global leader and spokesperson on place-based impact investing. This has been something Lauryn's been focused on for more than a decade. So, not only early in impact investing and ESG, and sustainable development goals, but in place-based impact investing. And Lauryn's also going to talk about sort of how she came to this, because she comes to it from a finance industry, as well as a pension trustee and a nonprofit board member. So before we get started, let's do this. Nick, if you can fire up the poll. So everybody get ready to enter your poll results. We have 2 questions. The first is just to get a grounding of how you're thinking about it, and Lauren's going to explain how she thinks about it. What does place-based mean to you? Does it mean your neighborhood? Does it mean your city or town, your county? Is there a region inside your state? Is it your full state? Is it a multi-state region when you think about place-based? Is it a continent? Is it just the whole world? So that's question number one. We allow you to pick one. And then question number two, you can pick as many as you like, is if you were to invest in your place, which of these parts of your portfolio would you think would be applicable? Cash and savings that might go into local credit unions and sustainable banks, loans that might include community development loans, CDFIs, muni bonds through not only a city, county, or state, but also through a hospital or a school or road system. Public equities in terms of who's based in your community, private equity and venture capital to advance private companies, real estate development and developing, could cryptocurrency and tokens be used, or other types. So check which ones you think you might use in your portfolio or be usable, and answer definition on your definition of place. We'll give it another second. Lauren, as a preview, do you have a preview answer that you want to start sharing?
I hope a lot of people have started to think about this and could check as many asset classes, because we'll find out that most of them can be applied somehow to your place in the collaborative network that we can focus on.
All right, Nick, if we're ready, let's wrap up the poll. And we'll see what the results are in just a moment. Okay, here it comes. All right, interestingly, 44% of people say my sub-state region, so bigger than your neighborhood, bigger than your city, bigger than your county, smaller than your state. So that's the number one answer, 44%. Interestingly, the next biggest answer is the world. People are thinking globally versus something more local. Multi-state region is the next one. So a mix of sub-state and multi-state region. So a larger maybe ecosystem or natural resource area. All right, so that's fascinating. And then question number two is, okay, if we were to invest in a sub-state or multi-state region or your state, how would you do that? And 81% of you have said muni bonds. So cities, states, counties, but also schools, hospitals, water systems, energy utilities. So this is really insightful. And then next up is real estate. So sort of the physical real estate in everybody's area. And then also strong private equity, public equity, loans, and even cash and savings. And then Lauren, check this out, 25% say cryptocurrency or tokens. So,
I don't know how to do that.
That's all right. We'll have something for a future ESGX. So, yeah. All right. So thanks everybody for participating. That helps, give us a pulse on the audience, Lauren. I can see from the audience, there's investors, investment advisors, people who are fund managers of impact investing. So this is little, experienced and sophisticated audience. But tell us, Lauren, how did you come to this? Like, you have a mix of finance and impact in your background. How did all this come together?
Thanks, Paul. It's really great to be here with you and Nigel and Nick and the whole gang. Place-based impact investing came to me through a question when I was serving on the United Way of the Bay Area as the chairman of the investment committee. And we were setting up some policies about investing the endowment fund and some reserves and things like that. And a board member asked me whether or not we could align the endowment fund with the mission of reducing poverty in the Bay Area. And I thought that was a pretty interesting question and didn't know how that would be applied. But I began to think about that. And at the same time, I was also serving on a large pension plan here in the Bay Area, the San Mateo County, and it's now almost $4 billion. And I began to wonder why we weren't investing in our own backyard, because our employees and retirees, of course, lived all over the Bay Area. And it was easy to see that the Bay Area has a lot of benefits, but it also has a lot of challenges. And going forward, things like transit, housing, sea level rise, energy and pollution, density, equity. All of these things make a big difference to the future of the Bay Area. And what could we do about it? Well, I began to realize that our financial service industry looked at globally diversified portfolios. And it was not very popular to think about taking a portion of your portfolio and allocating it to a certain place for impact as well as return. And because I came from 30 years in the investment side, institutional investment management, both the buy side and the sell side, I understand the rules that fiduciaries have to approach. I understand how markets are done, made, indexes, strategies. And I said, if I could fit something within that framework, could we draw some of that capital to our local places if it meets the return and risk criteria of fiduciaries, but provides an ancillary benefit to our beneficiaries as well? So I started researching that and began to develop an equity portfolio that focused on Bay Area companies, Bay Area employers, with the idea for the United Way that getting out of poverty requires a good job. So we wanted to go and talk about investing in the companies that offer good jobs around the Bay Area, where we could, publicly traded companies, and there's a lot of them headquartered in the Bay Area. And they have some very big pocketbooks, and we could engage with them on their policies towards employees, as well as the environment in the Bay. That portfolio turned out to be very good, and you can look at the results of that on the website, BAIII.org, and that's the Bay Area Impact Investing Initiative. But we also started thinking about fixed income portfolios and real estate portfolios and infrastructure portfolios and private equity portfolios, and of course, short-term lending and cash in the community banks as the survey included. So while most of us do have globally diversified portfolios, I became confident that we could build place-based portfolios that would meet the needs of investors. And yet most investors haven't embraced that, and we haven't really formed those community and collaborative portfolios that could be directed both for risk and return profiles as well as for impact. So it's a big concept, and I think it's particularly important now after the pandemic, after we're seeing the various impacts of climate change and how different it is on different places. The solutions are bound to be different, and the resources are certainly different. And combining public, private, and philanthropic partnerships together seems like a good way to combine a lot of resources, a lot of different kinds of monies, and get to some of these solutions much faster.
Yeah, so Lauryn, you've looked at this holistically, and one of the ways is also what's related to the Sustainable Development Goals. And Nigel, I think you can put up a graphic. There's an interesting graphic from Tonic, the impact investing network of Tonic, that seeks to integrate SDGs and different types of capital. How is that relevant for place-based investing?
This was a fascinating chart that Tonic did, because it did try to map the current environment of impact investors, existing portfolios, I believe, into the SDGs. And what they found was that existing impact investors are investing across capital stacks, some in equity, some in private equity, some in different kinds of fixed income instruments and cash and things like that. And you can track what SDGs you are aiming for with different kinds of money. So what this says is that SDGs are not asset class specific. It can take a lot of different kinds of money to achieve each and every sustainable development goal. And taking that whole big picture, because most of them are global type investors that are in the Tonic network, what you could do is concentrate all of those strategies that are right for your place and focus them in the middle. That big empty spot right in the middle could be where all the best ideas for your place come together. The tools that you can use in your place. In the Bay Area, we can use public equities because there's a lot of publicly traded companies headquartered here that employ a lot of people and that own a lot of real estate and things like that. So we could, with them on place-based issues at table. We could also buy the bonds of municipalities and states and companies that are investing and doing things in the Bay Area, infrastructure, schools, transit bonds, housing bonds, these sorts of things, and create a good diversified portfolio that reaches several SDG goals at the same time for one place.
All right, so Lauryn, in your chapter in the Global Handbook of Impact Investing, now out from Wiley, thanks very much for pulling that together. It's a really superb how-to guide of how you could do this. You talked about 3 examples, one obviously in the Bay Area, another in Curitiba, Brazil, if you're spelling it, Curitiba, Brazil, and another in India. So what's in common or different among these different geographies? And can we use one strategy in those 3 different types of places in India, Brazil, US, or what's the same and what's different?
I think the overall philosophy of trying to use different financial tools in collaboration to achieve a common goal, that's what we're talking about. In India, it was poor farmers in various different regions who were going broke because the pesticides were so expensive. So a collaborative was formed to teach them pesticide-free farming, which saved lives through poison and things like that, increased some of their output, but also they used microfinance to help train and create cooperatives to help these farmers make that transition to less pesticides and a healthier community. In Curitiba, that was a long-term land use planning in conjunction with environmental consequences of flooding that Curitiba was experiencing. And when other places in Brazil took their government tax dollars, they built, I guess, ditches and corridors to get the water out. Curitiba thought about it differently and did a lot of executive and total place planning for land use so that it would convert a lot more green space in the inner city to protect against flood zones and provide a lot of extra parkland. But at the same time, it managed to increase density in other places, which they responded to by bettering the bus routes and privatizing some of the other services that the city was offering so that everyone got a win-win trade-off. They got bigger parks, better weather, better transportation efforts, and job opportunities that came out of it through this interactive system. So I think those are admirable, but small and unique, and every place is going to exhibit its unique issues. Here in the California and the Bay Area watershed, that was another good point about the poll, is looking at a sub-state region, you can infer watershed, and sometimes it's a multi-state watershed that is impacting itself in its transportation and its metro areas. In the Bay Area, certainly we've got commuters from Sacramento to Silicon Valley to Fresno to the Sierras to the coast, and we're impacted by fires and floods and earthquakes and sea level rise, as well as poverty and inequality and housing prices and congestion and things like that. So all of these things need to be addressed hand in hand, and to get the people at the table that can share their ideas and then share the monies and the resources around and fund them through a variety of risk and return vehicles seems like the best way for me.
Yeah, and so Lauryn, together we produced a report, you, me, and Nick, for the Urban Sustainability Directors Network, USDN, and we worked with a couple dozen cities to do that. Is that place-based impact investing to help finance climate action and equality and community? Does that fit with?
Yes, absolutely. And that comes, right down into, getting into city budgets and making policy differences. But one thing that study we did together taught me was that things are very different between Palo Alto and Oakland. And the resources Palo Alto has to implement a sustainability action plan versus Oakland and its budget. And so to me, the entire Bay Area needs to help itself work together, because we're all in Oakland and Palo Alto, and yet they have more money to address it in their own neighborhood and are doing more things than Oakland can. And Berkeley's got different problems, and North Richmond has got different problems, and the South Bay is going to be flooded, and our airports are going to be flooded. So we can't just go and say one micro community, can be fixed in and of itself. It can be improved, but really, we also need to take account that sea level rise doesn't mean that every city should just build its own wall.
All right, so we have a question from the audience. So Carrie Norton has written in, and she writes, I'm curious about the extent, Lauryn, to which you think about drawdown, like Project Drawdown with Paul Hawken, has 100 different types of solutions that cover climate and equity and the like. How do those fit place-based impact investing or place-based impact decisions?
I'm not familiar with that framework, but I would say that the collaborators in each place would know what the priorities are in that place. And that's who you have to ask. And that's who you have to bring to the table and say, because the Bay Area needs different things than Milwaukee needs, or the Great Lakes. Appalachian needs something different. The tornado and hurricane zones are going to need a different kind of sea level protection than we will in the Bay. I think all of these things need to be customized for a place. But there's great ideas all over.
Yeah, what have you seen that works? Because it's still early, right? You've seen this ahead of anybody else more than a decade ago. There are some examples from FB Heron Foundation and doing localized investing around different cities. There have been some attempts at like broader coalitions of people come together, but there's different city jurisdictions, different county jurisdictions. Some are for-profit companies, some are governments, some are nonprofits. So what's the glue that brings it together? What have you seen that is a component of some of the solutions?
In some cases, I've seen the community foundations or other large nonprofit might step up and say, I want to start something and I'm looking for collaborators. So we saw in, I believe, Chicago, the MacArthur Foundation teamed up with some community banks, and they're going to do some small business lending through their donor advised funds. And that's a tool. That's one of the tools I would put in the bucket. I would also like to say that pension plans are place-based, and endowment funds are often place-based, and corporate funds can be place-based to the extent that the majority of their employees might be in a single place. But by allocating a chunk of an entire asset allocation or a chunk of an entire portfolio across all asset classes means you can really spread the risk, but also spread the opportunities towards meeting a variety of solutions in one place, by investing in windmill energies and housing and new businesses, for example, in the region, and spreading your resources out like that. There's no collaborative efforts that I've seen that try to do that, because it takes a lot of work. And if you're only going to allocate 1 or 5% of your portfolio, doing that due diligence one by one is prohibitive. So what I'd like to see would be some organization or somebody to step up and fund a basic level of portfolios and an operation, so that we could say, write your check here, we'll distribute the money in these portfolios for these projects, and there could be some net new investment coming into impact for your place.
Yeah, this is really interesting. And Fadil and Scott, maybe you can join the conversation too, because we can talk about financing in a little more depth. The audience said muni bonds are one way to do this. There are muni bond mutual funds and exchange traded funds, ETFs, as well as separate accounts. It's interesting.
Tax-exempt investors won't be investing in those. So that leaves out a lot of choice.
But here's what's interesting is 70% of muni bond of money in muni bonds are individual high net worth investors, family offices, and the like, and who do get those state deductions. In some cases, there are some mutual funds that have tax exemption benefits to do state-based, California specific, New York specific, Florida specific investing, all depending on the tax situation, of course, because some of those states have different tax schemes. Fadl and Scott, you've been working with different regions like Appalachian region and the Ohio River Valley. And Scott, you've been, talking to countries that I'm not sure which ones I can mention, so I won't mention them yet. How are you seeing place-based impact investing roll out in those regions, Fadl, or internationally, Scott?
Well, Scott, if you don't mind, I'll get started with a little bit of the macro picture. I mean, what I love about this this conversation is that the work that Lauryn has been doing and Hip Investor and others have been doing is really ahead of the curve in terms of what needs to be done. And I'll give maybe the audience a little bit of a date about what's been happening sort of behind the scenes and publicly at the macro level. There's an international network of organizations called NGFS, the Network for Greening the Financial System, which has been established the last maybe 3 or 4 years ago, trying to bring in central bankers and financial regulators to address the lurking financial risks that are sitting on balance sheets of endowment funds, pension funds, insurance companies, banks, financial institutions of all kinds. This is what we call the carbon bubble. That is the impact of climate change will produce a whole bunch of stranded assets in real estate properties and oil and gas resources and so on, estimated at maybe $20–30 trillion at least. So the Fed finally joined NGFS 3 or 4 months ago. The Fed now has a climate change committee that's looking very carefully at this. The SEC right now also has a 90-day open period requesting input and comments from the public. Maybe we'll put this link in the chat for the audience to look at. Essentially, the SEC is trying to figure out how do we identify these risks and how do we protect pensioners, people who are investing and putting their retirement money on the table here, that will blow up with the impact of climate change. In addition to the SEC, the Federal Housing Finance Agency also has a 90-day open period because they're looking at serious risks for real estate properties, say in Florida and California, because we're looking at insurance companies literally refusing to insure properties, and with the impact of climate change, more of it will happen. And if there's no insurance, a bank will not issue a mortgage. And if there is an existing mortgage in a risky geographic location, who has those assets on their balance sheets? So all of this is already on the books as we speak. So what I like about this conversation is that we're ahead of the curve, because what is the Fed going to do? What is the SEC? What is the regulatory framework that has to be invented in order to mitigate those financial risks, impose new reporting transparency requirements so we can actually identify how bad this stuff is that's on the books right now, and then start seriously investing in the actual mitigation of climate risk, that is building the resilient infrastructure. A lot of it will have to be done at the national level with federal investment, but quite a bit of it has to be done at the local level with local endowment funds and family funds and pension funds that can use this approach to have a real impact in a place-based type of climate resilient impact investment that addresses both the social issues, the economic needs that will outperform fossil fuel-based assets, for example. We know that for a fact, and will have a serious positive impact on communities. So this is a framework that is being born as we speak. And I think having this conversation today will allow us to kind of sketch out what the possibilities are. And this is all within reach. I mean, the Fed today could lean into the municipal bond market with its firepower and really reduce costs and underwrite a particular direction in which investments can be moving for the next 10, 20 years to help us do this.
And it could. And what do you think the odds are?
I think it's going to happen, and I'll tell you why. Because if you look at the NGFS website, which is this network that's been really brainstorming this, and it's not just NGFS, it's the Basel Committee, the Basel Agreements in Switzerland. They also have a climate change committee. They've been looking at capital requirements. Because if you're a financial institution and you've been thinking, oh, I have my tier 1, tier 2, tier 3 capital requirements, I'm solid, I'm solvent, but then you look more carefully and you realize, uh-oh, embedded in this, safe capital cushion that I have here are massive climate risks. And when that blows up, all of a sudden you turn into an insolvent institution. This is very serious for the financial system in terms of financial stability. So they've been discussing this for the last 3 years at least. So there's all kinds of proposals for new regulations, capital requirements, transparency requirements, and so on that will be, put in place. The question is how quickly, how aggressively, how carefully will this be done? I think that remains to be seen.
Yeah, and I just put in the chat box for everybody to check out and read the climate scenarios for central banks and supervisors. Scott, what about you? You've seen this internationally as well.
Yeah, I think it's interesting, Fadl, that you said it's happening. I think you might agree that we might likely see it in, say, Europe or somewhere before we see it here, because they are a ways ahead of us on these things at the central banking level and financial regulation. And yeah, as you said, they're already they already have proposals for capital buffers, liquidity buffers, having the central bank alter its collateral policies for, say, the greenness of muni and corporate bonds. So those things are already being discussed. I don't know. I imagine some folks at the Fed here have paid attention to it, but it's not at that same level there yet. Although we'll see. Maybe the Fed will play catch up a bit. I don't know.
And how about in Asia? Because you've had some of these.
Yeah, Asia is like Europe, well ahead. I don't know as many details about it, but there's actually a speech. Oh boy, I think it was one of the somebody from the Monetary Authority of Singapore. I could be wrong on that. Just recently, where he argued that Asia was going to lead in greening the financial system. So we'll see.
Yeah, there were 80 some central banks that joined NGFS before the Fed, and a lot of them are in Europe and Asia.
Right. One of the things, and I have a question for Lauryn here in a second too, but just to stay with the Fed for one more minute. One of the problems that we have with the Fed that we've seen a lot in the last year, and it had to do with the muni facility, where the Fed made a facility that was that could have made up to $500 billion worth of loans. In the end, I had the figures, but it was, I want to say it was less than 2 billion, but I'll say it's less than 10 billion. So I know that I'm right. In terms of the amount of the peak amount of loans that it had made. And, and anybody who paid attention to it saw how they sort of fumbled with it several times in terms of trying to not make it too much of a subsidy, we might say. And part of it's from the Dodd-Frank Act that required the Fed to be careful about risks, financial risks to the quote taxpayer in these sorts of facilities. But it's as our friend Nathan Tankus has pointed out several times, the Fed already has the authority under Section 14.2 to make these loans, and it didn't need the sort of apparatus that the CARES Act provided, and ended up requiring it to worry about all these risks and so forth. But anyway, the larger point is the Fed hasn't made the turn from thinking about what is the risk of instability in the economy, of instability in the financial system, it's still at the point of what is the risk to our balance sheet, right? What is the risk to our profits? It's still at that point much of the time, particularly with stuff like the munis. So that was the point I was going to make there. Laura, I just had a quick question.
1 second. Hold your question 1 second. Nigel, did you want to jump in on discount rate?
Yeah, I was just going to make one point here, which is one of my favorite points about how much emphasis people put on any risks which sit out in the future. And folk in business like discount rates that can easily be at 10% or higher. And, what does a risk 20 years in the future look like if you've got a discount rate of 10%? Well, it's down at about 10% of its current value. Over 50 years, it's 1%. So even if you're using discount rates of 5%, which is unthinkable in most businesses, by the time you're looking at a risk even 20 years away, 2/3 of it has gone. Now, if any of these risks are regarded as certain, and most of what we're talking about are certain risks to evolve, what discount rate should you be using? It should be a cash rate, right? That's what everybody on the trading floor would tell you. And that puts a completely different complexion on the extent of risk we're dealing with and whether we should perhaps grapple with it sooner rather than later.
And Nigel, what about negative interest rates? Doesn't that make it more?
Well, that is a really fascinating thing. And I for one, I get pinged by life insurance people who say, we can move your life insurance. You've got this final salary scheme somewhere. Interest rates can't possibly go lower. And I say to them all, we're not even much below zero yet. So yeah, exactly right. It just shows there are some huge risks here which are undervalued by many people that are trying to grapple with them.
All right, shout out to Nigel for your Wizard of Oz graphics here, and
I like to use the analogy that that the polluters and such sold a long-term put option on climate change decades ago, and it might have infinite losses. And so if you think of it that way, then you're not discounting anymore, right? With option theory, if something's got those sort of losses or is off in the future, it's actually got a higher price now.
All right.
Yeah, and look, I'd say I think the corporate view is also, well, look, if we just go bust, then that's somebody else's problem. So we can take the profits out, and so long as you've taken the profits out, there's no capital left. That's somebody else's problem. Of course, the someone else is all of us, because we pick up the bill through it ultimately.
What was your question for Lauryn?
Oh, yeah. So this may be a dumb question, but take it whatever direction you want to take it. Since we were talking about regulations and SEC and such, I'm just curious from your perspective, is there something that could be done law-wise, SEC-wise, regulation-wise that would help push forward the work that you're doing?
Yeah, I think that one thing would be the Department of Labor that tends to make the rules on fiduciary duty. If they could allow fiduciaries who manage pension plans and large other people's assets and things like that to embrace ESG, to include it, to accept that it is information worth having in your decision, and that it's not some voodoo or excuse by Wall Street to raise some fees, but that it is valid new information that people are beginning to calculate, to score, to understand the materiality of it, and to have the flip-flop that we've seen come out of the DOL. And then that leads into SEC and the Fed and that sort of thing. But if they could all get together and say, come on, guys, the rest of the world has figured this out. We have got to acknowledge that these are risks. And if you are making investments without even thinking about these risks and building them into your portfolio analysis and portfolio construction, and looking about, what are the long-term positive and negative consequences of each and every investment you make in each and every asset class. Because impact investments happen with there's an impact with every investment. We've just never been taught to look at it. We've been taught to diversify globally, not invest locally with an intention of getting something in addition to our risk and return. And so that would be a really big step to clarify that. And then the attorneys, the staff, the consultants, they could all be forced to buy in and get the work done that needs to be done to really embrace the fact that these risks are here and they're coming at us faster.
So Lauryn, broke up a little bit. We have a little chat going here about like what's local or what's the percentage that could be local in the different definitions. So what do you think it could be? Like we're taught in finance, a globally diversified portfolio is the most resilient. Obviously the past year that's had some implications. We've talked about with, I've talked about this with advisors like Rick Mordesevich of Sonoma Private Wealth, like what part of your portfolio is based on self-sufficiency, like totally decentralized self-sufficiency in the age of COVID and inequality and climate action. So what should it be or what could it be? Should a portfolio be 1% local, 99% global, 10 and 90, 50-50? Should it be 100% local? What should it be?
I think that really is depends on whoever's owning those assets and what their intention is and what their mission is. And so for a donor as advised fund at a community foundation, that is obviously a place-based type investment, even though the funds will be allocated globally. The grants are probably designated to some specific purpose, but that's likely not somebody's entire asset. So I would say that a donor advised fund could be 100% place-based, because that would double down the work in a place-based organization like a community foundation. And so you could say that to the extent that my mission and my place are broad, I could go a little bit higher. If I was a family with a lot of wealth, maybe 10%. Maybe if I was a 10-year type family foundation that was that didn't plan on staying around forever, you could go 50% just to, and give half of it away in time. Or if you're a pension plan that really's got some strict fiduciary rules and needs to track, you could start with monitoring your tracking error, and start with just 1 or 2% and say, did this even impact my portfolio at all? By adding 1% to the local portfolios, or is that just a rounding error? And then you could test it the following year. Could I do 2%? Because if you look at some of the massive amounts of assets in different regions, like ours in the Bay Area, 1% of everybody's portfolio, all these giant pools of assets we have in the Bay Area, that's a lot of money that could go dedicated to investments in the Bay Area. Could make a huge difference on helping to transform a place that we are already all committed to. And I think that you've got to look at that for every place. You have to figure out how big your place is. Is it the Great Lakes? Is it Appalachia? Is it all of one African country or the state of Oregon or this sort of thing, and decide how much you can handle? It's a risk and return and impact question, and they should be balanced.
And Lauryn, you have examples of different capital stacks and project examples on the website, right?
Yes, we're posting, and in the book, of course, we had some stuff, but what we've designed on the website, in the blogs and in the research papers, was different ways impact investors can look at a place, or what would a place-based real estate portfolio look like that's diversified in every way except place. That all the properties are going to be in that place, but they could be commercial, industrial, residential, multifamily, green space, forestry, maintenance. It's all of those things would be in your place portfolio. And the same with private equity, angel, mezzanine, and the debt portfolio could be very diversified to place. And eventually if you had a pool of assets that was dedicated to place, it could be perhaps the catalytic money that goes into new solutions, new housing enterprises that marry the transit-oriented affordability, sea level rise conundrum here with access to jobs and fresh foods, things like that. So lots of good examples are out there. We've tried to point out some places that are doing great things on small levels that could be scaled. Any place that works. So that's what we're always looking for, is good examples in different places. And I should say that the handbook offers a lot of place-based examples in gender, financing and other environmental finance. Yeah, hold the book up. I've got it in my corner right there. So.
All right, the Global Handbook of Impact Investing, published by Wiley, also available in online booksellers. Choose the ones that vote for unions or don't.
And yeah, each chapter's got place examples that could be moved to somewhere else.
Great. So Scott, one quick question, and then we'll do a wrap up of you.
Yeah, hopefully this is quick for you, Lauren. Just curious, since I'm in Kansas City, and it'd be nice if I had the ability to have a nice Kansas City portfolio. But what do you think about people like, say, myself saying, oh, you know what, I can also have a San Francisco part of my portfolio and a Ohio part of my portfolio where bottle is and so forth. What do you think about that sort of thing, about someone like myself being able to dip into place-based portfolios all over?
Well, they don't exist.
Right, but I mean,
but
in terms
otherwise,
of,
it'd be a great idea. Why not?
Okay.
Why wouldn't you? You could have, a Mississippi River portfolio, that could address a lot of the problems that are up and down the Mississippi. So I think those things are great. But our problem is that Wall Street and financial services has not created the product lines that are place-based. So if have a small portfolio and I say, I'd like to put 10% of my portfolio into the Bay Area and 2% into Montana, where I grew up, or the Rockies, there's no place to write the check that would provide me a diversified portfolio with a decent rate of return, either by asset class or even as a collaborative one piece of paper. So we have to create that first.
It's interesting that community foundations, which could be the natural landing spot for some of this, they have globally diversified portfolios. They don't necessarily have local portfolios like Scott's talking about.
Exactly.
All right, as we wrap up, Fadil, you want to go first, and Scott, and then Lauren?
Well, just one statement. I mean, it's clear from this conversation that, there is no deficit of ideas. There's plenty of ideas. There's plenty of, work that needs to be done. We have a clear vision in terms of what needs to be done on the regulatory front and on the impact investing front. And I think we just need to, get going and make it happen.
Cool. Scott?
I don't think I have anything really to add. That was all.
Your question was
fantastic.
Very insightful. I like the mix of different locales. So that was very insightful.
So, okay. I figured you'd already thought of it. So anyway, I yield my time.
All right, Lauren, wrap it up for us.
Well, I just would like everyone to think about it. And if we start asking more and more for a vehicle or a set of vehicles or an organization to come forward and create this, and maybe, some very wealthy philanthropists that would start the due diligence. But not everybody's got to recreate the wheel here. If we could do some collaborative efforts and community engagement, that is really where it starts. Those are the ways we find the answers. And then we network the rest of it and share. So thanks for the chance to be on a soapbox. I really appreciate it.
Well, we have more soapbox opportunities in the future. Lauren, thanks for all your leadership on place-based impact investing for more than a decade. Encourage everybody to check out the Bay Area Impact Investing Initiative website, BAIII.org. There's resources there. Of course, Lauren's chapter in the Global Handbook of Impact Investing. And let's put it to work. where ESGX is a community of action-oriented solutions people. So Nigel, over to you.
Fantastic. Thank you, Paul. And thank you all very much for a really fascinating discussion once again. One thought from Australia, from down under, is that some of the large mutually owned pension schemes there, so they're owned by their members, reached the view some years ago that they couldn't really expect to generate alpha from their equity portfolios because they were just too big. But if they invested in a way that improved the performance of the whole economy, then they would achieve better returns. I'm not sure what the Greek letter is for that, because it's not alpha because the whole economy does better. But I think that is an interesting point for us all to think on as well. So just to wrap up then, looking ahead to a couple of weeks' time, we have Tyson Yunkaporta joining us. He is an Australian academic, an Indigenous author who's written a book called Sand Talk: How Indigenous Thinking Can Save the World. And at the heart of this, for me, in my language, is the importance of systems thinking and grappling with the entire problem that we're trying to solve, rather than little bits of it in a very traditional manner. So please do join us for that. Details of that are at our website. And I'll just put up, this is what the thumbnail looks like. And this episode is going to be on the 20th of April in Africa, the Americas and Europe. That is the 21st in the Asia Pacific region. And with that, thank you all very much. And I will leave you with a quick preview of what's coming up. Western culture and government and business practices and financial market thinking is deeply rooted in a command and control mindset. From a young age, most of us have been taught to think in straight lines, to break problems down into their component pieces, to analyze how to solve each part of the problem and then to synthesize a solution. And once you've understood the problem and developed that solution, then all you need to do is simply persuade the right people to act. Of course, we all know intuitively that the world we live in is messier than that. Dealing with bigger challenges usually involves much more of society, and trying to affect change can be incredibly hard. And change is urgently needed. The threat of global warming has been predicted for 50 years, yet we've struggled to take decisive action. The growing conflicts between man and nature have been brought into sharp relief by the COVID crisis, yet still most people think improving sustainability must come at a cost to business. And the polarization of wealth and opportunity around the world is creating huge social pressures. Faced with all this, Tyson Yunkaporta's book Sand Talk: How Indigenous Thinking Can Save the World provides a thoroughly fresh and uplifting perspective on how to think about the challenges we face and how we can work together in new ways to create a better, more inclusive and more sustainable society. This discussion with Tyson is going to be truly mind-opening. As always, ESGX Live will be uplifting, down-to-earth and interactive, and if you register in advance at esgx.org, you can join our live audience where you can ask your own questions and contribute your perspectives via the chat. We very much look forward to the discussion.